Welcome back to the channel. I am very glad to be talking to you again today. And what I want to talk to you guys about today is very simple. It's the hardest part about investing. The hardest part about investing and doing it well is doing research. Doing research is incredibly time consuming. It takes up a lot of resources, and basically you have to spend a lot of time reading very dry, very boring documents. That's what good investing looks like. You can't not do that in order to invest well, right? And the reason why is because you'll never understand a company deep enough to make good choices if you don't do a ton of reading. You need to be constantly reading things, right? The things that you need to be reading are quarterly reports, 10Qs. You need to be reading annual reports. Those are 10Ks. All of these are documents that are required to be filed with the Securities and Exchange Commission. Doing these things is hard. It's time consuming. It takes some practice. It takes some learning how to read these documents because they all come in the exact same format. They're standardized forms for the Securities and Exchange Commission. There are certain things that are required to be talked about in each of these documents. And the thing is that if you actually do read these documents and you go through them and you understand them, you're going to have a much better picture of what this company is and what this company does, right? And that's going to give you confidence, really, to say, okay, my evaluation is correct. The problem that you're going to bump into when you do this is that you cannot possibly in any world read everything about every company. It's just not possible. You don't have enough time in the day. Even people on Wall Street, right? Hedge funds, mutual funds, all of these companies, they have people paid to go through these documents. They pay people to go through these documents, and they still don't have enough time to go through every single one for every single company on the stock market. There's just too much information, period, right? There's just way too much information. That's the problem that you sort of face when you're investing in anything in particular. You have to take a lot of time and energy and devote it into a single company for a fair amount of time in order to really dig down and understand that company. That's kind of a hard thing to do. It's an investment in and of itself, right? So what you need is you need to have a way that you can sift through a bunch of companies fairly quickly in order to tell whether or not it's worth your time to read an annual report, to do some serious digging, look at the notes to the financial statements, which hardly anybody reads, right? If you actually do read that, you're going to understand things at a much deeper level than a lot of people. And you're going to see that listening to quarterly earnings calls. You'll hear analysts talking about things and you'll understand what they're talking about. Otherwise, you sort of be lost. You're missing part of the conversation. The thing that I keep coming back to when I do this is you need a way to sort through all of these companies fairly rapidly. So how do you do that? Well, you cheat. You use shortcuts in the research process. My shortcuts are that I look at the return on equity. I look at the return on invested capital. I look at the return on incremental invested capital. Probably should do a video on that. And then I don't even look at earnings per share, because really how much money a company is making is kind of irrelevant, which is almost blasphemy to say that. And the reason why I don't is because there's a lot of games you can play with depreciation and blah, blah, blah. That's why people come up with measures like EBITDA, EBIT, blah, blah, blah. Adjusted EBITDA, right? There are so many different measures of profitability for a company and different ways to game each of those. But that's not even the biggest problem, right? If I told you company A makes $5 per share and company B makes $5 per share, that's useless. That is useless information. Because if company A, it's $5 a share, is a 50% return on equity or invested capital or whatever, right? And company B is a 20 basis point return on invested capital, equity, blah, blah, blah. You immediately can say, hey, company A looks a lot more attractive than company B, right? Company B seems to be struggling here, even though they have the exact same earnings per share, which is something that a lot of people don't really talk about. There's a lot of focus and emphasis on, hey, these are the earnings. And look, they're making a ton of money per share. But how much money did it take to actually generate that? Right? If you don't know how much money it took to generate that, like it could be a terrible return, even though it's technically a fairly large amount of money. So I tend to not like to look at earnings per share or even earnings. I like to look at it in terms of a ratio, right? Earnings to equity, earnings to invested capital, earnings to assets, whatever, right? And these are known as return on assets, return on equity, return on invested capital, blah, 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 right? And you can use your own favorite custom earnings metric, right? The only time that that I make an exception to this is with free cash flow. And the reason why I make an exception with free cash flow is because free cash flow sort of represents owners' earnings. It's probably the closest, most standardized metric to owners' earnings. I tend to look at it per share because I am not rich enough to buy the entire company. Wish I was, but I'm not paying $50 billion. I don't have $50 billion. I'm going to be paying per share. So that's one of the things that you want to look at, right? Is that, and you don't even want to look at that in relation to itself. You want to look at that in relation to growth and the return that you want to get to generate a net present value for the company based off of those factors. And you'll come up with some sort of valuation, and you'll go, oh yeah, this is, and that's really how I use my valuations, right? At least my initial valuations. What you do is you go through and you go, okay, this is what the company is worth to me based off of its free cash flow. And I tend to look at how consistent that free cash flow is, and how consistent the growth of that free cash flow is. That's useful information. Because if it's not consistent, then it's low quality, and you have to discount it heavier. But yeah, that's the general idea. And looking at it, you take a look at all of this information, and you get the mathematical answer from the free cash flow discounted analysis, discounting the free cash flows. And that gives you a mathematical answer. But then you look at return on equity, you learn return on assets, return on invested capital. You look at how consistent those things are over time. You look at all of that sort of stuff, and you start formulating in your head whether or not this is a fairly decent number, if it's going to be a fairly accurate number, if this number is fairly off, what have you, right? But then you end up with a very simple equation, right? Can I buy it for less than what it's worth to me? That's all that you have to do. You just say, is this company worth trading for less than it's worth to me? And, or is it even in the ballpark, right? In my opinion, if it's not trading at a discount to that initial, toss it to the side, move on, look at another stock. Again, because what you're trying to do is you're trying to go very, very quickly through the stocks to find one that's worth investing your time in. And that's it, right? That's all that you need to do. And if you do that, you're going to throw away, I would guess you're going to throw away 90% of what you look at within a couple of minutes of starting to look at it. That's just been my experience in the market. You'll take a look at a company, you'll throw it away within a couple of minutes. This works for older companies, more profitable companies, companies that are more established. For newer companies, I tend to place a larger focus on revenue, right? Is revenue growing? You got to check that box. Then I look at return on incremental capital. I look at losses, right? If it's a newer company that's growing rapidly and they're reinvesting into the business like crazy, and they're reinvesting debt, and they're reinvesting share equity that they've sold, dilution. You take all of that, you factor it all in, and you look at that and you say, okay, what you want to know is the return on invested, is the return on incrementally invested capital enough to grow at a rate that will get your company to profitability. That's the real secret to investing in non-profitable companies. You want to look to see if your returns on incremental I want to make this clear. It's not invested capital. It's incremental invested capital. And you want to look at how much it cost the company to acquire capital, right? The cost of incremental capital is sort of the idea, right? So if the company goes out and borrows at 5% interest, maybe, who knows? It's an unprofitable company. They borrow at 5% interest, and the return on incremental invested capital is 7%. That means that they are netting 2%, and you should decrease the losses by 2% a year. Rough estimate, you just do 1 divided by 2%, which would be 50, right? It would take 50 years for a company in that situation, roughly, to become profitable. That's just math, right? Will it actually take 50 years for that company to become profitable? Maybe, maybe not. Things change. New companies are very dynamic. They have lots of opportunities to invest in front of them. Choosing that sort of thing is difficult, and it's hard to do that. There's a lot of qualitative things that you need to bring into that. But as a rough estimate, it would tell you how many years you have to wait until the company would become profitable. I say that because, this is all just spitballing off the top of my head, just the way that I think about these types of companies that are producing losses. And what you end up doing is you go, okay, am I willing to wait 50 years to get a profit from this company? And you could actually project that out, right? The losses would decrease, blah, 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 right? Because you're doing it by a percentage, it's going to decrease exponentially, which would look sort of like a really low amount, and it would go towards zero. Obviously, that's not what's going to happen. What's going to happen is you're going to cross that line at some point and become profitable. But it gives you sort of a rough estimate. But you could actually do the math and figure out exactly how long it would take to get to like zero, right? When you get below a penny loss per share, you could project that out using, cost of incremental capital and the return on incremental capital, right? You could sort of project out how long it's going to take for this new company to become profitable. Then you can start talking about discounted cash flow from that point, and then it gives you a value and blah, 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 right? That's sort of how you look at companies that are currently at a loss, that are growing, right? It sort of gives you the growth rate of that company. So that's sort of how you would look at a loss producing company. But for the most part, I steer clear of those. At least I try to. And the reason why I try to steer clear of those companies is because, like I said before, there's a lot of qualitative things that you're going to be looking at with those types of companies. And qualitative things, there's a lot of difficulty in evaluating something qualitative about anything, right? It's way easier to value cash flows. But yeah, the idea here is that you'll be able to project out when that company would become profitable, and then you can look at cash flows and you can say, okay, how much is it, given the cash flows that I'm going to get and the losses that I'm going to sustain, how much is this company actually worth to me today? What I've found is that when you do that sort of analysis for unprofitable companies, you're going to get a value that's much, much lower than the market value. The market sort of gives these companies premiums because they do grow. They do tend to grow, and they do tend to sort of exceed those expectations. But it gives you a baseline value, right? And you can sort of adjust that up or down for qualitative reasons as you personally see fit. But yeah, the idea is still the same. You get cash flows, right? And even if it's unprofitable today, it's not always necessarily going to be unprofitable. And then your analysis looks exactly the same. The problem is those losses are front loaded in your discounted value, which is why you seem to get really low values for these types of companies. Yeah, that's how you would do that. But again, the idea here is not to be perfect, right? With these companies, the idea isn't to be really good with these companies. That's not to get the complete story. It's not to get everything that you would need. The idea here is simply to get the information at a very, very high level and determine, okay, this company is worth this to me. This is the amount it's trading at currently. Should I spend more time analyzing this company? That's the criteria that you're looking at this very preliminary stage. You are just looking at some very, very basic statistics about the company and saying, is it worth my time to continue looking at this thing? And like I said, for 90% of the stocks, I dare even say 99% of stocks out in the universe, the answer is no, it's not going to be worth your time to continue on this stock. The market is an eternal optimist, as it should be. Stocks have done very well historically, right? But markets get over optimistic all the time, and they get overly pessimistic sometimes. In my experience, I haven't been doing this for a ton of time. I don't have a bunch of gray hair in my head at the moment. But I have gone through several crashes at this point, and I went through the 2008 crash. I went through the 2020 crash. I wasn't in the market during the .com crash, so there's that. You can sort of nick that, mark that against me. But I've been through a couple of crashes. The market does get pessimistic, and it gets pessimistic for several years at a time. And we may be in that sort of mode at the moment, right? We had a very long bull run with just one real blip, right, in that bull run. But again, the idea is how much time can you don't have time to look deeply into everything. So how do you decide what's worth your time to look at very, very deeply? And 99% of the stocks that you look at, you're going to look at it and go, nope, too bad. Nope, too hard. Nope. And you're just going to keep tossing things off to the side, right? You don't have to look at a stock for very long to say, this is not worth my time. And that's what I do, right? And that's what I spend my time doing, is just going, nope, 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 nope. Oh, hey, maybe, right? That's the thought process that you're going through with these stock valuations. And that's the thought process that I'm going through as I'm doing these stock valuations here on YouTube. So, like I said, it's not an immediate no if a company is unprofitable. but it's definitely a strike against it. And the only reason why it's a strike against a company if it's currently unprofitable but growing, and it looks like a good investment from like, oh, this is a small company, it's growing rapidly, they're expanding. I have a couple on my radar that are like that, right? I haven't pulled the trigger on any of them. The reason why I haven't is because those are inherently harder to work with, and require more time. You have to put in more time into those, so you can't just go check, 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 no, 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 right? And then you get to this unprofitable thing and you go, it's almost already a no because it's unprofitable, not because I have anything against that. It's just I'm already going to be spending more time than I want to spend on this company, right? That's really the problem with unprofitable companies. Is that I look at them and I go, this is going to take more time to analyze than it may be worth, right? I'll spend more time than it's worth to look at that unprofitable company. It will take more time and effort. So that's sort of the idea behind doing these investments, doing these valuations. It's not to get a perfect valuation. It's not to be the most accurate. It's just to get you in the ballpark to say yes or no. Should I spend more time? That's it. That's all that you've got to do. So that's all that I've got for you guys. I know this was a little bit of a longer video, but I did want to sort of explain how those valuations work, right? And why I actually don't spend a lot of time looking at any particular company. All right. Thank you for listening, and we'll talk to you next time. Peace out.